Welcome to the 3 Power Moves to Become Your Own Bank Masterclass. Hello, we are live, and happy to be here. Welcome on this Thursday night at 7 p.m. We are live on Facebook right now. We are live in our Zoom room right now. And we are just so happy to be here. I have some people who tried to get in and popped out. You know how it is. People say, oh man, it's something good for me to do. I'm driving and I just got the link. So while I'm driving, I'm going to see if I can learn something. So some people are trying to get on still. I am both your wing woman and your host. So that means I'm letting people in the Zoom room. And I am hosting the presentation, hosting the workshop. I am so super happy, so super excited. Feel so super blessed to be able to share this information with the entire world. Let me tell you something. Every human being on the planet should know how to be your own bank. Being your own bank is a concept that I believe should have been taught to us in junior high school. You know what I mean? Because if we had learned this in the 8th grade, well, it's middle school. I'm dating myself, y'all. So if we had learned this in the 8th grade, just simple math, how do we make our money grow? That should be, it should be taught in the 6th grade in elementary school. How do you make your money grow? And then by the time we're doing division, we should know Einstein's law of 72. That is when you take the number 72 and divide it by how much interest you're earning on your money, it tells you how fast your money double. We should learn that as soon as we learn arithmetic and division and multiplication, right? So just imagine if you started in the 6th grade learning how money grows, and then by the time you're in the 8th grade, you know the basics of bank account. When you go to the bank, you open up a checking, you open up a savings. Statistics say that if you open up a basic savings account, or I don't really believe in savings accounts, y'all. It's got to be earning at least 5% interest. But if you can get a savings account, a high yield savings account, earning at least 3.5% interest, statistics say that your child will be financially independent by the time they graduate from college or high school. And I want to tell you something right now. I started Solomon and he opened up a bank account at age 12. And right now, only God knows how much money the boy has saved. You hear me? But I can tell you that even after not working for several months, he was able to buy his own lifeguard equipment and uniforms. He's self-sufficient. He takes care of his own hair and his own clothes. And a lot of times when he's at work, he pays for his own food, and he can live on his savings for several months and then grow it. So he learned the foundations of being your own bank. And I think that it's unfair that only a certain privileged few get financial education in grade school. Are you with me? So for that reason, you'll see that I am extremely passionate about teaching financial literacy, because financial literacy, I believe, is for all. What do you think? Do you think I'm right? Do you think? So if you're on Facebook right now and you are in agreement with what I'm saying, I'm gonna just ask you for something simple. Let me turn this down. Hold on, y'all. I made one basic mistake here. I actually didn't turn the volume down. That's basic mistake number one. Whenever you go live, make sure you turn the volume down. Let me turn this down. Okay, hold on. Make sure you turn the volume down on your second device. That's why I need virtual help, y'all. I'm hiring a virtual assistant. Because I'm not an octopus. I shouldn't be trying to do all these things, right? So yes, we are. Since I'm on here, we are hiring a virtual, well, not just a virtual assistant, a personal assistant to me at $2,000 per month salary plus commission, which is not bad. You understand what I'm saying? So if you are interested, you need to be licensed. I prefer a person that has a license in the life insurance business first because they already know the basics of what I'm doing. They know a little bit about underwriting and the different things that I need done administratively. So if you are a licensed agent professional looking for $2,000 per month fixed income salary plus commissions, and you believe you feel a infinity and you feel an energy or a draw towards me, and you would love to work with me personally, then I want to invite you to reach out to me and send me your resume at Rhema, RHEMA financial coaching at gmail.com. We want to get someone in this position by August 1st. So today is the, let's see, what is today? July the 11th. So we want to have this filled by August the 1st. Okay. So, again, life insurance background, administrative background, you must have a Zoom background. If you have a background where you can go high level and funnels, that's going to be a plus. So there, yeah. And if you know how to handle a calendar, a virtual calendar, a Google schedule, and you feel an affinity for me, then this just might be the opportunity for you. You need to be able to work at least 30 hours a week or more, and you need to be able to travel if we need you to travel to conferences, because I have already 3 conferences booked where I'm speaking in August, and just to go with me to Florida, Georgia, South Carolina. We're in the South right now. Okay, so sometimes I'm in different churches, sometimes they're virtual workshops or different things like that. So that's what we're looking for. Okay, so does that sound good? All right, so I feel like I did some church work. I got some things off the table, okay? So listen, if you get this notice and you're on Facebook, jump on in, come on in, get in here. Get in here, get in here, okay? Get on in here and learn this financial literacy. This is free. It cost me something. As a matter of fact, just last week I had to pay just a couple of $100s to get another level of structuring for indexes in accounts. So it always costs me money to get this financial education. But guess what? We are given it in good faith that it returns to us, like the Bible says. Good measure, pressed down, shaken together, and running over, will good men give unto you. That's what the Bible says. So we're standing on faith, and we're standing that he that sows a seed in good ground shall see a return 30 and 60 and 100-fold. So we're standing in faith as we sow these good seeds of financial literacy into our community, that God will multiply it and return it and give it the increase. Can you believe that for me? Can you believe that for yourself? What about you on Facebook? Can you believe it? Can you believe it here in this Zoom room? Okay, so I actually ran my mouth in hopes that some people would actually get a chance to get in here. But since we are, how far are we? We're about 14 minutes into the hour. I'm going to go ahead and get started. Is that all right? Well, let's go ahead and get started. Okay. All right. So here we go. All right. All right. So what are we talking about today? We're talking about the 3 power moves to become your own bank. This is a way to create tax-free cash flow inside of a life insurance policy, inside of an account where you can just set it and forget it, and it pays you a good hefty amount of money for the rest of your life. This is about creating tax-free cash flow. What is cash flow? Cash flow is passive income. What is passive income? That means you sit at home and do nothing, and money deposits into your bank account. It can be monthly, weekly, annually. It can be daily. It's making money in your sleep and not having to work, and money comes into your sleep. Money while you are asleep. Right? You're letting your money do the work for you. You set it and forget it. It grows and it pays you for the rest of your life. That is the goal. And then suppose you could make that income tax free. My God, we pay enough in taxes. We pay at the restaurant. We pay at the pump. We pay taxes when we are born in the hospital. We pay taxes when we die, death taxes. Don't you think we pay enough in taxes? Suppose we can eliminate them or even minimize them on our retirement income or our passive income. Wouldn't that be the dream? Well, there are people who are already doing that. And how in the world are they doing that? So that's what being your own bank is all about. Okay? Being your own bank is the ability to leverage a loan and turn it into cash flow, tax-free cash flow. Woo! I gave y'all a lot. So listen, a little bit about my background. I started in the industry back in the 90s, knocking doors in Southeast DC. In the rough part of Southeast DC, knocking doors. Do you hear what I'm saying? Selling whole life insurance through Globe Life Insurance. I paid the price, but didn't know it. But at the end of the year, I hit the $1 million round table back in 1996, y'all. But because of financial segregation, I did not know that I hit the $1 million round table. The $1 million round table is simply a group of six-figure income and above professionals who have an inner circle who go away on trips and do conferences and plan wealth all over the country. It is a high-end award for financial professionals. Hit it in 96, hit it in 97, and it became a habit. So one year I went to a conference at Globe Life, looked at the charts, and I was number 7 out of 200 agents in the company. So I found myself sitting at a round table. Number 1 was there, I can't forget. Chubby Caucasian man, about 60 years old. He was number 1 in the country. Number 2, number 3, all the agents were sitting around, and I want to say these were the top 10 agents at Globe Life, and I was there, and I was the only one representing my agency. They were looking at me because this was the second year that I was there. So they were like, wait a minute, you must know what you're doing because this is the second year that you found yourself here. So they respected me. They respected me because I had done it twice. So, and then the people who were my managers weren't at this conference. So guess what they did? They pulled me to the side and they got in my ear and they said, Rochelle, everybody at this table earns $100,000 a year to as much as $2 million a year. What are you doing? At that time, I had only earned $35,000 for the entire year. And that was a wake-up call for me. What is it that they know that I don't know? Obviously, there's something, right? So I began this journey to find out what they're talking about in these back rooms and why is it so isolated? Why is there such segregation, literacy wise, right? So from there until now, I'm not going to go through the whole story, but I'm going to tell you that in the early 2000s, in 2008, when the recession hit, I quit the life insurance industry. My clients were canceling their policies, trying to eat, trying to pay their bills. So I ended up with thousands of dollars worth of chargebacks. And in order to save And my son was 1 year old at the time. And in order to save and rescue me and my son was 2. He was about 2 years old. So in order to save our behinds, I quit the industry and I went back into fitness and teaching dance full time. And I never looked back because the industry kicked my behind. Long story short, you know, people say if you want to make God laugh, tell him your plans, right? Because what happened was the pandemic hit in 2020. And what happened? We lost all of our exercise physiology, exercise rehab, and dance education jobs. We all shut down, right? Because of the pandemic. Same thing happened to me. I shut down, started trying to live off of my 401k, the little bit that was left. Before I knew it, Solomon and I were struggling to make ends meet. Solomon and I were door dashing in the middle of the pandemic, trying to make ends meet. Can you imagine that? Can you imagine me and my 12-year-old son door dashing to try to make ends meet? That's what was happening. So Solomon and I, a girlfriend of mine at Victory Christian Ministries, thank God for Victory Christian Ministries, a girlfriend of mine in the dance ministry there, she said, Rochelle, I think I have something for you. I know that you're looking for something to make some money. And do you know what she did? She set up an appointment with me, and her manager sat down on a Zoom call, and they showed me the concept of life insurance. But they showed it to me from something I had never seen before. Y'all, hold on a second. I'm trying to stop sharing so you can see my face. There you go. So they showed me taking a life insurance policy and turning it into a tax-free income. And I'm like, what the ham and cheese sandwich is this? I've been selling whole life since I was 19 years old. First, I didn't believe it. I was like, y'all lying to me. I don't believe you can take a cash value life insurance policy and turn it into a tax-free income. I don't believe it. But then I began to do my research because I joined her agency under her. She was glad to have me, boy. She recruited a rock star, you hear me? And I joined underneath her and I began to learn. And I'm going to be transparent with you. That was WFG. Okay, those of you who are in the industry, you know what I'm talking about. So they showed me this, and then they had these educational platforms, and I began to learn about this thing called Index Universal Life. I was like, oh, this is cool, right? I knew about Universal Life, but I didn't know anything about Index Universal Life, and I didn't know that you could do so many things with it, right? But the wake-up call for me was they showed me that you will never, ever be financially free unless you create passive income. They shared Robert Kiyosaki's book called The Cash Flow Quadrant. And Robert said that in order to be financially independent, you can't trade your time for dollars, which means you're trading your personal time for a paycheck. You've got to be free of working for a paycheck. And he said the only way to be free of working for a paycheck is to set up, and 2 ways. He said to set up an investment account or several investment accounts that create cash flow or passive income. He said the second way to be financially free is to build a business with at least 400 employees and business partners that create passive income, which means the Walmart family do not work at Walmart. Do you understand what I'm saying? They have businesses all over the country that create billions of dollars of passive income. He said that the breakthrough point for your business is when you have 400 people working a business system that you created or that you're under, and those people are working that system. Therefore, you are receiving passive income. And I was like, that changed the framework of my brain. I began to do something I had never done. Well, I did a little bit, but I didn't understand what I was doing. I began to recruit and train and help get licensed new agents and even older agents, agents that I knew in the business. And I began to share with them this new thing I found. Taking an index universal life and being your own bank or a whole, and then I began to learn that you can do it with a high cash value whole life policy. And then I began to use index accounts. So as my financial literacy grew, so did my portfolio. So did I grow as a person. I began to see that there's more than one way to create tax-free cash flow using the be your own bank concept. So I did it again. I had did it in the 90s, but I did it better. So from 2020 to 2021, I hit the $1 million round table again. I was just doing what I knew to do. And I wasn't even working that hard. I was mostly training my agents and maybe writing a few policies a week. And before I knew it, they said, hey, you personally put over $178,000 on your own personal pen of premium dollars. Those are policy to policy. It equaled about 200 policies for the year, I want to say. You wrote 200 policies for your personal pen, and your agents did another 100,000 in premium. I'm like, oh, they ain't even working. No, nobody's really working. They not really working. I'm not really working, right? But during the pandemic, I earned my ring again. I had earned several rings before, six-figure income rings. And in March of 2021, I caught COVID. And my son caught it first. So we were living we were in our government subsidized apartment in Woodbridge, Virginia. And I'll never forget, because my son went down. He went black. It was scary, y'all. If you ever had COVID, he was in the back room. And we took him to the hospital, did all that. So he was just in his bed. And then I was in my business suit on Zoom. I began to black out. I'll never forget it. I remember like somebody pulled a curtain over my eyes and everything started to go dark. My lungs got hot and my head started spinning. And my last silent words to myself was, who's going to take care of Solomon if I die? And boom, I went down on the couch and I was in my business suit. I woke up the next day. The next day was Friday. It was the first Friday in March of 2021. I woke up and I was trying to struggle. And it's the first of the month. You got to pay your rent, right? You got to get food on the table. So I looked in my bank account app and I said, there was a direct deposit in my bank account today for $2,000. I was like, where'd that $2,000 come from? I didn't write one policy because I had been out with COVID and I couldn't. And then I went down again and I tried to do more calls. I tried to see people. I couldn't do anything. I was struggling with COVID. The second week, another $2,000 and some change deposited into my bank account. Then it happened the third Friday and the fourth Friday. March of 2021 was the first time I had ever made, I want to say about $11,000 to $12,000 for the month. And it was mostly passive income. So I looked into it and I said, where's this money coming from? This equals $100,000 a year in passive income. So I noticed it was coming from two places. I had done what Robert Kiyosaki said we were supposed to do. It was coming from the agents who were out there that I had trained for the previous year who were writing business, and they got it, and they got their own system, and they were just cranking. That was number one. Number two, the year previously, I decreased the cost of my life insurance in my index universal life, and I began to overfund my index universal life by about 60%. So about 60% of the money that I was putting into my IUL was going into a Roth IRA, or a tax-free account that was sitting in there. And that policy paid me two ways. It began to pay me as earned income. I'm not going to tell y'all what that is, but it's as earned income. And it began to pay me little checks off of it that were extra. So you're like, what in the world? So that was a breakthrough moment for me. That was when I was like, this is it. This is how you create cash flow. All right. So listen, I want the same thing for you, because I was a single mom on welfare, struggling with her son, trying to make ends meet. I didn't know anything about any of this in 2020. So if I can do it, you can do it. God has no respecter of person. All you have to do is put the things in place as I did and overfund those policies. And if you have a business system and you can teach other people how to do it, it's a win-win, because they make money and you make money. So everybody's happy. You understand what I'm saying? So listen, you don't have to be a rocket scientist. You don't have to be super smart. You just have to follow the principles of how to be your own bank. Does all of that make sense to you? All right, so I'm going back to hide means control. Now, I didn't really plan to tell my story that long, but my heart started pulling on me. So I hope that you enjoyed that story, okay? So I want to know something. What is it that you expect to get from me if you're in this master class? What are you looking for? Are you looking for a policy that you can use to be your own bank? Are you looking to make sure your retirement income is not lost on the stock market? Are you looking to alleviate the taxes out of your retirement income? Have you received a lump sum of money from your company, and now the company is saying that if you touch it, you owe them federal taxes, state taxes, and an early out penalty, and you just want to know how you can avoid paying all those taxes? So if that's what you're looking for, you're in the right place with the right person, watching the right video, okay? I have good news for you. I don't charge my clients. Sometimes I feel like I should charge them because they pull on me 24 hours a day, but I don't charge them any money. Our agency, we don't charge for services. Yes, we are licensed. Yes, we are fiduciaries. Yes, we are. Yes, we are qualified to talk about the market and retirement planning. And normally, if you talk to someone who is a licensed fiduciary, they're going to charge you a fee up front. First, they're going to make sure you have at least $100,000. Most of them want $250,000 in assets. If you don't have that, if you don't have at least 100,000, they're not going to talk to you. You're going to have to do it yourself online. But in order to be a personal client, normally they want you to have $250,000 in assets. And let me tell you something, they don't consider your 401k an asset. Why? Because you don't own it. Your employer owns it. The IRS owns it. You have no rights, no liquidity, and no control. So anything that you don't have any liquidity or control over is not an asset. You have to borrow from the IRS in order to get money from it. And having to borrow money, they don't consider that liquid cash where you can get it when you need it. So you might have, oh, well, I $500,000 in my 401k. They'll work with me. No, they won't. It needs to be something you own. If you have it in an IRA that you own, then yes, they will. But if it's at your employer, forget it. No, they're not going to work with you. That's just it. Okay. So why are you telling us all this, Rochelle? Because we don't charge fees. There are commission fees when you do life insurance for someone. There's a 1 to 2% broker fee that's attached to brokerage accounts and retirement plans. And then there's an upfront $5,000 to $20,000 or more to do wealth management and to walk you through the process, to teach you the stock market and recommend where to put your money. We don't charge. Do you hear what I'm saying? So how do you make money if you don't charge, Rochelle? We charge by referrals. Who do you know that we should know? We work by referrals. Qualified referrals. So if we get together on a 30-minute discovery call where we get to know each other and we both decide that we want to work together, you decide yes, I say yes. Before we get started, on the second time we meet, we're going to ask you to write out 10 good referrals. Now, we're not talking about people who are struggling financially, right? We're talking about people who already have savings, people who already have retirement plans, people who need life insurance and they can keep it. Not people who are barely trying to struggle and who would lapse a policy because they're not doing well with their finances. We're talking about 10 quality referrals. In exchange for those 10 quality referrals, you have a relationship with us for the rest of your life. There is nothing. Our relationship with you is going to be worth millions of dollars throughout your life. I still work with my clients from 1992. They call me, I call them, something happens to them, I fight new tooth and nail to make sure their family gets paid. I will drive from Virginia Beach to Forestville, Maryland, wherever they are, to make sure their family is straight. Do you understand what I'm saying? And make sure little Tutu who got $100,000 knows what to do with it and can keep it and can grow it. Do you know what I'm saying? So nothing is more valuable than having $1 million round table, ring earning, integrity loving, strong woman of faith that's got your back. There's nothing more valuable than that relationship. You picking up what I'm laying down? So that is our charge. And that allows us to educate our clients without having to worry about commissions. That allows us to cut our commissions. I told a lady on the Zoom call yesterday, I said, listen, you've got high blood, diabetes, and quite frankly, you're overweight, and you've got insulin dependent diabetes. I'm going to have to take a 50% commission cut to get this life insurance policy in your budget. And I said, and I showed her the difference right in front of her. I structured the policy in front of her. I said, this is what the company would charge you. I'm going to take a 50% commission cut, and this is going to be your new premium. And this is going to be the amount of cash value that you have in your policy. She said, oh, thank you so much, Miss Rochelle. I know if I was in her house, she probably would have jumped up and hugged me around my neck. And I said, but this relationship, you're not going to be able to find this policy from anybody else. But let me tell you, you owe me. My pay is what? 10 referrals. Let me show you something. I'm going to show y'all something. Do you know what she did? Let me show y'all what she did. I'm gonna show y'all what she did. Let me show y'all what she did real quick, real quick. This reminds me of Jeffrey Robinson. Back in the day, Jeffrey Robinson used to do this when he taught us. Jeffrey Robinson was like 20, 27 years old, and he had made $500,000 a year. He was the GOAT, right? So he used to teach us this back in the day. So she jumped up. She saw the commission cut that I had to do to get her policy. And do you know what she did? Check it out. You see that? Those are all fresh referrals. Can y'all see? I don't know if you can see that. It's a page of fresh referrals. And the page goes on. Do you understand what I'm saying? Because she was so grateful. So I can't even call them. I have so many people to call. I can't call them. But she was so grateful that we're not charging her a broker fee. And that's for her life insurance. We're still helping her boost. She works for Health and Human Services and the state. So she's about to retire and take her, what does they have? I think they have a 401k, and we're going to help rescue and boost that. So it's a whole relationship, yeah. But it allows us to educate people without having commission breath and, just trying to get a pay and then tell them they can't get the policy because they can't afford it and all other crap. You understand what I'm saying? All right, so moving on. Okay, how come this one? No. Hey, I'm trying to move on. Okay, go. What am I doing? I'm trying to click the forward button. If I don't get myself a personal assistant, I am telling you, somebody better come rescue me. Because I shouldn't even be doing this, quite frankly. This clicking stuff. Okay, meeting. Yeah, I need to take this part out my hands, y'all. All right, let me see. Let me see if I can exit out of it. And then I don't even have my glasses on. Reset the toolbar. Okay, let me see if I can do this. I'm sorry, y'all. I'm trying to figure out what I did to not make my Zoom presentation not go forward. Okay, there we go. Did I change screen? Okay, so those are the companies that we work with. I don't know what I did, but I was clicking away. But those are the companies that we work with. The one thing that you'll notice is that they're all A-rated or better. So an A rating with AM Best and Standard & Poor's. What is AM Best and Standard & Poor's? Those are the companies who rate life insurance companies and investment companies. And in order to get an A, you have to have excellent customer service, can't have a lot of complaints. You have to pay your claims on time. And I believe the standard right now is you have to have at least 60, it's either 50 or 60 billion dollars in assets. After you pay your claim, you have to have multiple billions of dollars left over in just surplus cash. So all of these companies, you will notice, National Life Group's 175 years old. Foresters is 150 years old. Mutual of Omaha is like 100 years old. Equity Trust, okay, Emeritus. So you'll notice that I don't work with those little small companies. I've worked with them before and lost all my clients and my book of business. Do you understand what I'm saying? And lost my book of business to the agency who took my book of business. So that's a whole nother story, right? So we don't work with small companies and we don't work with agencies that'll take your book of business, all right? We only work with A or better, and I recommend you do the same, okay? Now, why am I clicking and why is it not 40? I don't know. This is a new one, y'all. Hit exit. I'm gonna hit exit. Okay. If I hit exit, and then why isn't it not forwarding me? Let me see what's going on. I am on a conference. Solomon, please. Oh, I'm sorry, y'all. What's going on? Okay. Hmm. I don't understand. Stop sharing. Okay, I'm gonna try it again, y'all. Go back in. Thank you for your patience, y'all. If you're still here with me, I'm telling you, I need a virtual. There we go. I see it. Oh, I see it. I know what I'm doing. Okay. I see the arrows. Okay, there we go. Thank you for your patience. All right, so listen, who are you financially? What kind of person are you? Do you know the Bible says that where your money is, there will your heart be also. So wherever you put your money, that place has your heart, your attention. Money, you went to work all week long, or you go to work 40 hours. Sometimes people work 60, 80 hours, and they put all this education and time and energy into earning money. And then when you take your money and you give it somewhere and you do something, that's where your heart is. The Bible talks about a story where Jesus was standing at the altar and he was watching people put money in the offering. Y'all remember that scripture? And Jesus noticed a widow woman and she dropped a penny in the offering. And he was teaching his disciples about people's heart. He said that she has the biggest heart. She gave the most because she gave all she had, right? So when you're putting your money into something, it talks about your heart. Are you with me? So we're asking you, are you an investor? Do you have an investor's mindset? Well, what does that mean? That means when you put your money into something, does it just evaporate? Which means it's gone, like a bucket with holes in it. You put your money into things that depreciate in value. A lot of clothes depreciate in value. Cars depreciate in value. They make you feel good today, but they wear out, right? Renting, renting an apartment, you have no equity in it, right? Or are you an investor? You only put your money in places where it's going to multiply and return to you 30, 60, and 100 fold. So are you putting your money in places that make the money grow? Or are you putting your money in places that make the money depreciate in value? If you are a saver, you have to be very careful. Savers, they're good, which means you have money for emergencies. You're practicing the principle in Proverbs. I want to say 22. I believe it's the book of Proverbs. It might be Proverbs 12. The Bible says, go to the ant, sluggard, consider her ways, how she sets money aside in the summertime. So in the summer, in the spring, ants are hustling, grabbing pieces of everything and taking it back to their burrows. And then in the wintertime, you can't find them. Why? Because they have plenty of reserved. So when the ice and the winter comes, they don't have to worry about it. They have plenty of savings, right? So if you are a saver, but you also have to be careful that you're not a hoarder, right? Because there's a fine line between saving money and hoarding money. When you're hoarding money, your money is going to start decreasing in value. So you're putting your money in a bank and the bank only pays 1% interest. So now as the cost of living goes up, your money is decreasing in value. Or you save your money in a cookie jar, or you dig a hole and put it in the floor, or you don't want to spend it. You're scared to spend it, right? So you've got this hoarder spirit over it. You don't want people to know that you got it, right? You're fear releasing it because you don't have an investor mindset. So you don't see how when you release it, you get a 30, 60, 100% full return. So you're just hoarder. So Jesus talked about this in the Bible as well. He said, You poor and wicked servant, you took my money and buried it in the ground when I told you to take it and multiply it. Y'all remember that? So God expects us to multiply. When he gives us a seed, he expects us to grow a tree, and he expects that tree to bear fruit. Remember, Jesus walked past the tree, and him and his disciples were on the road, and he saw a tree, and it was beautiful, full of leaves. So he went over. Him and his disciples were hungry, and he tried to pull figs off the tree for him and his disciples. And they looked all around the tree, and the tree didn't have any figs. So Jesus got angry and he cursed the fig tree. Y'all remember that? And then the next day, the disciples came back on the road. They looked at the tree, and the tree shriveled up. It had brown leaves on it. Why? The disciples said, Master, there's the tree that shriveled up. And God said to them, a good tree bears good fruit. When I'm giving you seed, I expect that to grow and to multiply. That tree was lying to us, telling us that it had fruit, making us think we were going to be able to satisfy our bodies. And it lied to us. It bared no fruit. Are you with me? So God expects us to have a mindset of growing, of increase, of multiplying things, right? Not a hoarder's mindset where we just take the money and we sit on it and we don't bless other people. We don't multiply it in the earth, but all we do is sit on it, and then the money decreases in value. Are you with me on that? Money is very, very spiritual and very, very sensitive. So and because it's connected to our heart, which is our spirit, right? So we have to be very careful. We have to be mindful, and we have to self-correct when it comes to what are we doing with our money. Then there's the mentality of the spender. The spender doesn't care, doesn't look. They look up and they just buy, and hope that there's a good balance, right? Or the spender just has to have already has 10 pair of shoes, 20 pair of shoes, but got to buy another 50 pair of shoes. And it becomes hoarding, because those shoes are going to do what? They're going to decrease in value. As you wear them, you're going to have a closet full of old shoes. Eventually, that'll be out of style, or that'll be worn out. So what's really happening with the spender? The spender is the one that has the credit cards and just swipes them down to the line of zero, right? So how can we reverse all this? We can reverse this by being our own bank. And what does that mean? Being your own bank is leveraging. What is leveraging? Leveraging is being able to borrow money from an institute and make money with the money that you borrowed. That means I can trust you with money. So if I loaned money to you, I knew that you were going to pay me back plus interest. So if the bank loaned you money, they know you're going to pay them back plus interest. They got a return on their money, 30, 60, 100, 10, 15%, right? So being your own bank, let's take a look at how banks operate. When you deposit money into a bank, what do? They take your savings and lend it out to other people. So let's just say I deposited $50,000 into a savings account, which I would never do. Actually, I would put it in a money market if I put it anywhere, so that it could earn 3, 4, 5% interest, because I don't believe in 1% interest. That's horrible, right? So let's say I took $50,000 and I put it into a money market account. No, I wouldn't put it into a CD, because CDs are not liquid cash. They have penalties. They have taxes, they have surrender fees, they have commission fees as well. And if you need them in the case of an emergency, you can't get them. So you will find rich people don't have a whole bunch of CDs, okay? It's just, You just don't. Okay, but in a liquid money market account, and let's just say my girlfriend Donzella, well, let's just say Donzella came in a few days later and she applied for a car loan, right? So what would they do? And she wanted a $50,000 car loan. She wants a luxury car. So they would check her credit, and let's say her credit was challenging. So they would check her credit and say, well, your credit score is less than 600 or is 600. So they're going to charge her 15% interest. So what they're going to do is they're going to take my money, loan it out to her, and they're going to charge her 15% interest on my money. So the bank makes money on other people's money. The bank doesn't own their own money. You put your money in the bank and they take your money and loan it out to other people. Banks are allowed to loan out your savings 10 times and recycle it. Okay, so here this bank loaned it to her, made 15% interest off her, loaned it to him, made 12%, made 24% off that guy because that guy really had shot credit and needed one of those really bad loans, right? And 29% off that person who really had bad credit but was desperate for a car, right? So that is being your own bank. Being your own bank is the ability to flip a loan or to make money off of a loan or to wash out the interest on a loan, to get free money, to make a loan, to turn a loan into free money. That is the ability to be your own bank. So what is the problem? Why is it that we have such a hard time financially? Because we're programmed to spend our money down to the line of zero. So what does that mean, Rochelle? So that means we put money in the bank. People, I want to put myself in this, y'all. We put our money in the bank, and then an emergency comes up, and what do? We take all of our savings or all of our money out, and our bank account goes down to the line of zero. Then we work our behinds off to put the money back in there, and we take it back down to the line of zero, right? Or we do it with a credit card. We get a credit card, charge it all up, take the credit card down to the line of zero, pay them back, and then do it over and over again. So taking our bank accounts down to the line of zero over and over again. Well, how do you stop taking your money down to the line of zero? This is how. Listen up. You keep your money in the bank and keep it growing and use your bank account as collateral for a loan. You take the loan, you use that loan to do whatever it is you have to do, as long as you take the loan to make money, as long as the loan is increasing your net worth. You borrow money to increase your net worth. You only borrow money to increase your net worth. You do not borrow money to buy clothes. Depreciating asset. You do not borrow money to buy jewelry. You shouldn't borrow money to buy a depreciating car unless you're making money from that car. That car is getting you back and forth to work, getting you back and forth to college. You're renting that car out and making passive income from that car. That car is attracting abundance to you, right? So if that car is increasing your net worth, right? You do write that down. You only borrow money to increase your net worth. Then you have the mentality to be your own bank. When you borrow someone else's money, guess what? Your money stays there and continues to grow. You use their money to increase your net worth, not your money. Your money stays inside and keeps growing, and you use their money to increase your net worth, not your own money. Therefore, by never stopping the forward growth of your money should never stop growing. Never stop the forward momentum of your money. Again, these are investor mindset. This is the $1 million mindset. So if it went over your head, don't feel bad. We should have started learning about growing money when we were in elementary school so that we could have a consciousness of how to grow our money. So it took me years and I'm still growing. You understand what I'm saying? So I don't want you to feel like I don't understand what she is saying. She sounds like she's saying some Chinese to me, right? Don't feel bad about it. Stand, keep listening, keep growing until your consciousness grows. When your consciousness increases, this will make more sense. Okay? So listen up. Every investment account has holes in it that leak out money. The biggest hole is taxes. Taxes are going to take 40% of your savings. What makes you say that, Rochelle? If you have a 401k, a 403b, a 457 plan, a whatever, if your retirement plan starts with a number 4, it's a 400, that means it's a tax deferred plan, which means you're putting off paying your taxes until you need the money. So that means taxes are growing. Your tax liability is growing inside the plan. So when you go touch it, you're going to owe state taxes anywhere between 3 and 13% interest, federal taxes anywhere between 22 and 39% interest. And if you're younger than 59 and a half years old, you're going to owe another 10% taxes on top of all 3 of those. So any way you slice that cake, it equals 30%. 30% or more you're going to owe in taxes. Fees, we just talked about it. There's brokerage fees. If you have a 401k or a thrift savings plan, the government, your employer, they're in bed together. So the IRS, the brokerage firm, and your employer are all getting paid commission fees off of your 401k, thrift savings plan, etc. They're in it together. They get their commission fees whether you lose money or not. So if you lost $10,000, $100,000 on the stock market, it doesn't matter. The broker, your employer, and the IRS are still getting their commission checks. Fees, it's no joke. Low growth. Let's just say these glasses, if you can see these glasses, let's say these glasses cost $1 at the dollar store. They cost more than that, actually. But let's say they cost $1. And then next year, let's say you went back to the store. Actually, let's make it more reasonable. Let's say they cost $10. Okay? And then you went back to the store next year and the glasses cost $10.50. What happened? The cost of living increased. So the cost of living increases by 5% or more each year. So if your money is growing at less than 5% each year, your money is depreciating in value. All right? So low growth depreciates your money in value. And the last thing is losing your money on the stock market. Now, people say, well, the stock market will come back up. Yes, it will come back up. And you will recover. You won't win. There's a difference between recovering your money and growing your money. I'm going to say it again. For those of you who aren't quite sure, there is a difference between recovering your money and growing your money. So don't be put to sleep thinking, oh, my money came back. My money recovered. If it took a year for your money to come back, you lost money. You lost buying power. You lost opportunity cost. You lost the opportunity to grow your money. For one whole year, your money sat still and or decreased. So unless you are financially literate, where you know how to buy the dip and get 30% or more on your money, you're losing money on the stock market. In order to win, you have to get 30%. Why? Because you have to pay taxes. On anything you have to pay taxes. In order to really grow your money, you have to make more than the taxes you pay back. So you have to have a 30% increase. That is an investor's consciousness. I hope y'all catch some of it. There's two different types of banking systems. There are the public banking system and the private banking system. There's a mistake there, y'all. Oh no, I get it. Okay, so there's a public banking system which consists of your checking and savings account, your credit union, your money market, your CDs. It consists of your 401k, IRAs, and anything where a judge can hit the hammer and seize and freeze your account. Anything where if you owe a debt, you can wake up tomorrow, look in your bank account, and it's gone. The debt is wiped out. Especially if it's a debt of taxes, property taxes, student loans, things like that. Old debt can come and wipe out anything in the public banking. The private banking system consists of your money inside of a trust, your money inside of a life insurance company, be it a life insurance policy, cash value, whole life, universal life, an annuity, an account, a Roth IRA, anything inside of a life insurance wrapping is under, the death benefit is under the 77028 tax code, which is the code that makes it tax free. It avoids probate. Probate, what is probate? Probate is when the government seizes your money. Let me give you an example. Let's talk about OJ. How did OJ protect his money? When OJ was finally convicted, the judge convicted him of, I don't remember it was manslaughter, but I remember that he was convicted where he had to pay, his estate had to pay all of his assets. So they freezed his assets and they took everything he owned. Okay? He went to jail. And Forbes magazine reported that he had $6 million still left in assets. But it was in life insurance companies. It was in annuities. It was in accounts. And it was all wrapped in trust, living trust, guarantor retain annuity trust, IRA trust. So when OJ came out of prison, Forbes magazine reported that he earned $600,000 a year in passive income and that the Goldman family could not touch it. OJ has since passed away, and his children and those he named on his trust are still the only ones who can touch his money. Can't touch this. So the private banking system, everybody on the planet should have several different private banking systems. Just in case you wake up one morning, look in your bank account, and the IRS attached a lien to it, or a creditor or a loan attached a lien to your bank account. You should have money someplace else that would take care of your expenses. Okay? What happened to the Black Panther? Chadwick Boseman's. Well, it was reported that Chad's estate was worth about $4.1 million. By the time funeral expenses, death taxes in the state of California, state taxes, property taxes, debts that he owed where he was advanced money on certain projects. You understand what I'm saying? By the time Chad's estate paid out, his estate lost 70% of its value. Y'all understand? Which is sad. What should Chad have done? He should have done what OJ did. Make sure you have life insurance cash somewhere, whether it's an annuity or an account or a high cash value policy, and make sure you have trust, living trust. You put your life insurance accounts inside of a trust, and you are now in the private banking system. And instead of transferring that money to the state of California and to debtors and to whatever whatever pictures company that he owed, that money would have went to his mom, his dad, who are in their 80s, and his fiance and his brother. Right? Who do you want to get the money? Your state, the federal government, your debtors, or do you want your family to get the money? Well, you got to make sure you have a private banking system. All right. So, Rochelle, you promised us 3 power moves where we can use it to become our own bank. The first power move is to be able to leverage the life insurance company's money to make money. One of the easiest ways to do that is by owning an index universal life insurance policy. This was the policy I discovered and began to overfund during the pandemic of 2022. I learned that E.F. Hutton created this policy in the early 80s. In the 80s, there was a life insurance war. On this side, you have A.L. Williams. A.L. Williams created something called buy term and invest the difference. The problem with what A.L. Williams did is that it didn't work for the majority of the population, because the majority of the population is financially illiterate. People don't know how to use the stock market. And if you don't know how to use the stock market, it is guaranteed that you are going to lose your money. Putting it out there. Are you with me? So because people don't know how to self-insure and use the stock market and flip your money and hold on to it, then you still have to pay capital gains taxes on that. But hold on to it. E.F. Hutton's, A.L. Williams concept didn't work for the majority of people. The other reason why people couldn't do it, it didn't work, was because those term policies expired and the price went up to $400, $600, $2,000, $4,000 a month to keep the term policies. At age 65 and above, the life insurance companies started pricing people out of the market because they were older and sicker. So people lost their life insurance. They had no savings because they were financially illiterate, and they had no life insurance because they wanted to get cheap life insurance, and it was nice while they were in their 30s and maybe even 50s, but as soon as they hit 60, it was horrifying, right? And they didn't have any more life insurance, and they didn't have any more savings. And A.L. Williams, that concept failed on a long term with a large population of people. So E.F. Hutton took a look at this and said, wait a minute now, I think we can come up with something better. So E.F. Hutton created this policy called the Index Universal Life. This is where you get a permanent life insurance policy, similar to a whole life, but not. Okay? This is where you get a permanent life insurance policy and you pay off the policy. You pay it up. Paid up permanent insurance. Pay it up. And then you invest the difference in a fixed indexed Roth IRA. What is that? It is a tax-free retirement plan that gives you stock market interest and you don't lose a dime. So he put a fixed index Roth IRA inside of a permanent life insurance policy. And wow, he created something that would beat every life insurance policy on planet Earth. And rich people started shoving money into it. They were shoving millions and millions of dollars. And E.F. Hutton and all his circle of the good old boys, all his inner circle of good old boys got super stinking rich, and their clients got super stinking rich from creating it. If you want more information about the history of this, Google the rich man's Roth, and you will find more information about this policy. Well, the concept wasn't necessarily new, because back in the 1930s, the affluent had something called an high dividend paying whole life insurance policy. What is that, Rochelle? Dividends are when you own shares or you own a piece of the company. So when you own a piece of a company, you get paid an income from it called a dividend, right? Prudential says own a piece of the rock. So you own a piece of the life insurance company in these policies. You become a shareholder of the life insurance company when you get this policy. So Walt Disney purchased, and the where I found this story is PBS documentaries. Walt Disney, the Disney story. That's where you will find the information that I'm giving to you. Okay? So the PBS documentary reports that Walt Disney bought a whole life policy when he first got married for $2.5 million. They tell you the value. And then he kept it. And in the 1950s, he wanted to open Disneyland in California. But he didn't have the money. He went to the banks, and in the 50s, banks did not believe in theme parks, because in the 50s, theme parks were for gypsies and people scamming and selling snake oil. So they would not loan him money for his idea for a theme park. So Disney realized, hey, I've got this whole life policy that I've been funding for 15 years, and I can borrow from the life insurance company. I don't have to borrow from the bank. So he borrowed $100,000, according to this PBS documentary, from the life insurance company. Now, when you borrow money, that means your cash value stays in the policy and continues to grow. You use your cash value as collateral for the loan. You use your death benefit as collateral for the loan, which means you never take your money down to the line of zero. You use their money. So he borrowed from them, used his cash value as collateral just in case he couldn't pay back the $100,000, and he used that money. And he also did the same thing with his house, the equity in his home. So he pulled out the equity in his home, and he pulled out a loan from his life insurance policy, and he bought the land in California. When Disney first opened its doors the first day, Disney grossed $2.5 million. So Disney used a life insurance. So he paid back his loan, and the documentary even tells you, we know what the interest rates were on whole life back then. They were about 2 or 3%. So he paid back $100,000 plus 3%, but he made $2.5 million on that loan. That's being your own bank. Wealthy people have been doing this for hundreds of years. Ray Kroc, who started McDonald's, did the same thing to start McDonald's. The people who J.C. Penney opened J.C. Penney did the exact same thing. All right, and the list goes on and on. So you'll find a list of people who do this concept. All right. So power move number one is being able to borrow money to make money or to leverage a loan. All right. Power move number two. I'm going to skip this part just for timing. Power move number two. Power move number two is being able to create passive income from the money that you have saved up. Passive income is the key to financial independence. Think about it. What is a pension check? When you have a pension, it is a savings that you actually, where you put your own money into it, and then it pays you an income that lasts the rest of your life. Suppose you could create enough passive income where you didn't have to work anymore and all your bills are paid. Think about the peace of mind that comes from that. So being able to create passive income is power move number two. And we found that the best way to create passive income is by using your own cash. If you can, use your own cash to create passive income. And you're thinking, well, where would I get this cash? It could be equity in your home. It could be a lump sum of money that you have saved, right? But we found that the best tool to use to create passive income is something called a fixed indexed account. Why do you say that's the best way? Well, fixed means when the stock market crashes, your money sits on the floor of a fixed interest rate and you don't lose a dime. Life insurance companies will pay you a guaranteed interest rate called a fixed interest rate. Okay? So that's the F. Index means you have a chance to earn stock market gains. So the S&P 500, the Russell 2000, so fixed index. And then the A means account. It can be a growth account. And if it's a growth account, that account's going to pay you bonus money. The insurance company is going to drop bonuses into your account. So many different types of sweet bonus accounts. Or it can be an annuity, which means it's a rider on the account that will take that lump sum of money and make it last for the rest of your life. Okay? So a fixed indexed account. We found that that is the absolute best way to create passive income. Now here's a quick lesson that we should have learned in middle school. We should have learned this in the 8th grade. There are 3 different types of accounts that you can put your money into. The first type of account is called a fixed account. So that is when, let's just say you buy a CD and it says 3% interest, and that's it, right? It's not going to go higher. It's not going to go lower. It's fixed. The problem here is if it pays less than 5% interest, your money is depreciating in value. The cost of living goes up by 5%. Your money is only growing by 3%. So every single year, your money is decreasing in value by 2%. In the industry, we call this flatlining. Boop, you hear that sound? It sounds like somebody died in the emergency room. Flatlining, fixed interest rate, right? We believe that fixed interest rates should be floors so that when the stock market drops, your money sits on a fixed interest rate. You don't lose anything, okay? The second type is called a variable account. This is where you're buying stocks. index on the stock market. So as you can see, it looks like a heartbeat. It goes way up, but then it goes way down and you lose your money, right? So that is a variable account. It goes up and down, up and down. The problem with this one is if you don't understand the stock market, it is guaranteed that you're going to lose your money. You'd have to depend on a broker or someone who is licensed to teach you the stock market. And that means you have to find somebody trustworthy so that when the stock market crashes, you don't lose everything that you have and you still need that money. That was money you were depending on. You never put money that you were depending on into the stock market. That money should be someplace else. Here is the third type of account that we don't learn. This account is a secret to most people. It is called a fixed indexed account. It is a combination of both fixed and a variable, so that when the stock market crashes, your money sits on the floor of a guaranteed interest rate. But when the stock market goes up, your money goes up with the stock market. So it is stock market gains and zero losses. So imagine if you had $200,000 in your retirement account, and then the stock market went up and you earned $80,000 on that money. Y'all picture that? But then the stock market crashed. What would happen to that $280,000 when it crashed? You would lose, right? But just imagine when it crashed, your money held tight. It was just sitting there. Or it even grew by a little bit, like 1 or 2%, because it was sitting on the floor. Y'all picking up? And then when the stock market went up, you stacked money on top of that 280. Whoa, you stacked another $30,000 on top of that 280. So now your account went from 280 to 90, 300 to 330. While that joker who had his money in a variable account, his account lost 50,000, right? So now that joker's under 100,000, 150,000 trying to catch up. So because you didn't lose money, you're at 330,000, where people who lost their money are just trying to recover. So there's a difference between recovering and winning. There's a difference between recovering and growing your cash. You with me? You don't want to just recover your cash. You want to grow your cash. And we believe that a fixed index account is where your retirement money should be. We believe that your retirement money should not be on the stock market, because the stock market is for your fun money. It's for the money you can afford to lose. It's for the money, even if you're a savvy investor and you can day trade, right, with the best of them. You know how to make money on the stock market. That's not the place for your emergency funds. Your emergency fund should be in a money market account at the bank so that you can go get it in the case of an emergency. You don't have to worry about it not being there because the stock market is down, right? Your retirement account is the same way. That is the money to take care of your future self. When your body doesn't feel like going to work anymore, or you can't go to work anymore due to health issues, that's that money. It's supposed to be for financial security. It should not be out on the stock market. Should you put money into the stock market? Yes, absolutely. But you have to build your financial house securely. Your financial house starts with insurance. Why insurance? Because you want insurance to pay you in the case of an emergency and take care of you. You have to insure your money, just like you insure your house, just like you insure your car. You need to insure insure your money from losses. I bet that sank in. I hope so. So we recommend this is the place for your retirement money. Okay? So are you going to show us one? I don't think so. I'm not going to show y'all one. If you want to see how it works and see how it grows, book a Zoom call with me. Okay? Go to Rhema, RHEMA, financial coaching at gmail.com and send me an email and I can send you my calendar. We can Oh, wow. Am I back on? It was a storm in Virginia Beach. The storm was so bad that boom, sounded like somebody was blowing something up, but it was the storm. And I guess it knocked out the Wi-Fi. And here I am, I'm back on. God is good, y'all. When you're doing the work of the Lord, I'm telling you, you'll be under a hedge. But you don't even realize you're under. Okay, so now I can finish. I can finish, okay? So I'm going to finish. Listen, listen, listen. Y'all with me? Still with me? All right, so let's do the third power move. What's the third power move? The third power move is to move your money into a trust. All day, honey. Everything you own should go into a trust. Your house, any property, your car, your retirement accounts, anything that you own should go into a trust. Why? Do you want the government to seize everything like they did with Chad? Or do you want to be like OJ? Even if you went to jail, nobody could touch your money. You understand? So to have your money paid to you out of a trust. Did you know that there are trusts that you can set up where you become the guarantor and retain the money that's inside of it? So you would actually get your retirement cash flow paid to you out of a trust. We're working with several lawyers right now. We actually have a team of lawyers. I've been on the phone with lawyers half the day long. They've been blowing me up, y'all. It's nice. It's been kind of fun, actually. On the phone with lawyers in different states so that we can direct our clients to the right law firms so that you can take these annuities, you can take your accounts, you can take your cash value life insurance policy, put them inside of a trust, and then you can't touch this, like MC Hammer was talking about, right? It'll be, once it's irrevocable, it'll become unpenetratable by law. You'll become like the Rockefellers. The Rockefellers own things that you don't even know they own. You drive by gas stations and even HBCUs and different things that the Rockefeller own, and they're being secured and they're paid for by their trust. They have a trust that funds and pays for HBCUs. They have a trust that pays for arts and different community things. They have a trust that pays gas station. They actually own a few oil and gas companies, but it doesn't say Rockefeller. But the Rockefeller Trust with S are paying for these things perpetually through time so that their family is always wealthy as long as you're born with a Rockefeller name. Did you know that? Did you know you could do it too? I mean, it's nice to hear that Rockefeller can do it, but what can I do? You can do it too. Even if you have just $100,000, say you have $100,000 in a 401k, and it's time to retire, you want to take that money, first thing you need to do is call me so we can boost that money, because you don't have enough money to have a decent retirement, okay? If all you have is $250,000, you do not have enough money to have a decent retirement. You're going to be drawing your money down to the line of zero after you paid your taxes. Before you know it, no matter how you slice it, your money is going down, 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 down to the line of zero. So it is not wise to spend your savings, because it's just a savings. So to spend your savings down to the line of zero, it is wise to perpetuate it and to make it last forever throughout time. So talk with me about a strategy where you can put it into an account that has a lifetime income rider that will pay you for the rest of your life while your money flips and grows and grows and grows. You don't want to run out of money, do you? Who wants to run out of money? Doesn't make sense, right? Do you have the saver's mentality or do you have the investor's mentality? Which means a saver is going to save money, and eventually something's going to come, huff and puff and blow that house down. Eventually there's not going to be any money left. The spender is just making a mess